Welcome back. Time now for the word on Wall Street. Top investors watching your money. Joining me right now is Infrastructure Capital Advisors CEO and ICAP ETF Portfolio Manager Jay Hatfield. Also with us is Mark Tepper throughout the morning. Great to see you. Thanks for joining the conversation, Jay.
Thanks, Maria.
Take a look at this market this morning, and we are seeing the market trade higher, extending the gains of yesterday. Dow Industrial's up 34. The Nasdaq's up 66 right now, on top of a 90-point rally yesterday. Interest rates back down to 4.1% in the 10-year. Take a look. We got the 10-year now at 4.10%. That is up just 0.2 of a basis point. Federal Reserve Chairman Jay Powell telling the House Financial Services Committee yesterday that the central bank is on track to cut interest rates this year. Watch.
We'd like to see more good, relatively low inflation readings. We're not looking for better inflation readings than we've had. We're just looking for more of them. The 12-month inflation will continue to drop because it'll be lower than early last year. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-run inflation expectations well anchored.
Powell will testify before the Senate Banking Committee today. And Jay, we're also waiting on the European Central Bank. And I know that you've been anticipating the ECB to move perhaps even sooner than the Fed moves in terms of lowered interest rates. Tell me about the ECB, your expectations, and the impact on the U.S.
Well, the data continues to be horrible coming out of particularly Germany. They had an 11% decline in factory orders for the month of January.
Wow, that's a big number.
Yeah, and 6% down year over year. So really bad data. We think the ECB is way too optimistic about their growth forecast of 0.8%. And this, just like our Fed, at the end of every quarter, they update their economic forecast. So we think that'll get downgraded. They're not going to be really bullish necessarily about cutting rates, but it's going to be implicit in that forecast. The lower forecast will, we think, validate our June call on a cut from the ECB.
Yeah, I mean, the ECB today is expected to hold rates steady at 4%. They'll announce that rate decision this morning at 8:15 a.m., so we'll have that for you in about an hour. But you say in the U.S., one of the biggest risks for the economy and for investors is this potential increase in corporate taxes, which the president is likely going to talk about tonight.
We think that's the absolute worst thing you can do for economic growth. It's an unmitigated disaster for two reasons. First of all, global competitiveness. The socialist countries, Scandinavian countries, they have low corporate tax rates, but tax everything else. That's the right model. That's what every other country in the world is doing. And it's terrible for the stock market because the after-tax return on investment drives the earnings multiple and growth. So it's the worst possible thing you can do for the economy and the stock market, and everybody else in the world agrees with that view, except U.S. Politicians.
But you don't think it's going to actually stick?
The Senate math looks very favorable. So
the Republicans take over the Senate in November, and maybe they stop it.
Correct, yes. We think that that's the most likely case.
Meanwhile, Mark, we still have issues with the banks. Look at New York Community Bank Corp yesterday. It's now agreeing to a deal with several investment firms. They needed a cash infusion. They're going to get $1 billion in exchange for equity. In this infusion led by former Treasury Secretary Stephen Mnuchin's firm, Liberty Strategic Capital. The stock is down 66% year to date. Look at this stock at $346 right now. Your reaction?
Yeah, that's a tough one. Look, I think it's great that they got their $1 billion capital infusion. That's going to give them a lifeline. Should keep them alive for, I don't know, another 6, 12 months, whatever it might be. But, Maria, we've been talking over the course of the last year or so about this looming commercial real estate crisis. But we've really been focusing mostly on office buildings, and specifically Class B, Class C office space. With New York Community Bank, interestingly enough, their issue is multifamily. And we have not been discussing challenges within multifamily at all. So that's apartments. The issue is that roughly 50% of their portfolio is rent stabilized. That came directly from Kathy Hochul in 2019. She said you can't raise rates that much, rent rates that much. And what that's done is that the cost of servicing their debt has gone up astronomically because of where interest rates have headed. They've either had to refinance or they're on variable rate mortgages, variable rate loans on these properties, but they can't pass through any of those increases, and they're getting squeezed because of that. So this is yet just another situation where progressive policies are disrupting the free market system and certainly putting banks in jeopardy. I mean, I don't even know who could step in if things end up going south with these guys to buy them. Probably not J.P. Morgan. I mean, maybe Citigroup. I don't know.
Yeah, I mean, who's there to pick up the pieces, right? I mean, JPM did an acquisition last time. They did it, but you made the point the last time we heard from Jay Powell that he took out that one line that the banking system
is resilient or whatever, sound resilient.
Sound.
Yeah, look, I mean, obviously there are some issues with the banking system.
Yeah.
And we've known that now for roughly a year, right? Because that's about a year ago is when we started to get the issues coming out of Signature Bank. You know, I guess that would, if there are issues in the banking system, you would probably expect Jay Powell to cut rates sooner than expected. But I got to tell you, that's not what I heard yesterday.
No.
What I heard is he's going to be very cautious and calculated.
Yeah.
I heard the momentum, maybe the 3-month moving average of month-over-month inflation is more important than the year-over-year going down. And it's been coming in at 0.4% month-over-month. That's a 4.8% annualized run rate. So, you know, I'm expecting fewer cuts this year than most.
Me too. I agree with you. I don't know how he cuts more than once, frankly. We're going to cut in June, but anything beyond that, he's going to get criticized for getting involved in the election.
Yeah, in fact, we think that next week's meeting could be a negative because the SEP may only show 2 cuts from 3.
Right.
So investors need to be cautious about that. But we still think the AI boom will keep the market rallying through the end of the year. That's why we have a 57.50 target.
And you raised that target, right?
We raised it by 250 points. Yeah, we were bullish at the beginning of the year, but it's obvious that this AI boom is going to keep the market. Like, this is the pullback. This is their pullback because we don't have earnings right now. But the AI stocks, like NVIDIA, is up every morning pre-market almost, no matter what. Yeah.
All right, Jay, great to see you.
Great,
Thank you so much. Jay Hatfield, Mark, you're sticking with us all morning, and we're so happy.